My name's Ethan Braid. Today we're going to talk about the probability of a crash happening in the stock market. We're going to look at this a couple different ways. We're first going to assess just the random probability that a crash could occur in any given year. And then we're going to try to assess what the likelihood is that we may see a significant crash in the market in, say, the next 12 to 18 months in light of all the uncertainty that we see right now and the economic indicators telling us that a recession is very likely in the next, say, 1 to 2 years. Here's what we're all afraid of, especially for retirees. A stock market crash that happens very quickly and takes a while to recover. What we're looking at here is the S&P 500 dropping in 2001 to 2003 and then again in 2008. Now, what is the probability that an event like 2008 or 2001 could happen in any given year? Let me show you. Here's a look at the last 14 bear markets over the prior 95 years. From 1929 all the way to the most recent bear market in 2022, the average bear market has been a 38% loss, and the duration has been 18 months on average. In any given year, you have a 15% random probability that a bear market could occur. You start every year with the probability that there's about 15% probability that there could be a bear market, and bear markets on average happen about every 6.8 years. Not all bear markets are associated with recessions. For instance, 1987, 2022, both had significant drops in the S&P 500, but there was no recession. So this is a critical data point to consider because recessions are almost always associated with stock market drops. And when we start thinking about the likelihood of a recession, I think the odds of a bear market become much more elevated going forward. Let me show you what I mean. Here's a look at the last 15 recessions going all the way back to 1929. We can see that the average recession has lost 31%, and not every recession results in a loss in the stock market. In 1945, the market went up 19%. Only 10 out of 15 recessions qualified for a bear market, which is a drop of 20% or more in the stock market. Some years like 48 and 53, we saw losses of 13% and 11%. So overall, we have a 67% probability that we may have a bear market, a drop of 20% or more. But we can say definitively that 14 out of 15 recessions did have a loss. So we're looking at a 93% probability of a loss in the stock market when we get a recession. The random probability of a recession is about 16%, a little bit higher than a bear market, and we see a recession on average every 6.3 years. So the random probability of a bear market at 15% or a recession at 16% doesn't sound too threatening. But I've been here before. Okay, I remember what it was like in the year 2000, and I remember what it was like in 2007, before we hit the skids on recessions and we saw significant drops in the stock market. So over the years, I've thought to myself, there just has to be a better way to go about assessing where you're at in the business cycle and what kind of risks we're looking at. So let me show you an economic indicator that can give us some guidance on how likely a recession may be. And then let's try and quantify the likelihood that we may see losses in the stock market in the next 1 or 2 years. Here's a look at my favorite recessionary indicator, the spread between the 10-year U.S. Treasury and the 3-month T-bill. Most of the time, that spread is going to be positive, and that's because we can generally get more interest from the 10-year U.S. Treasury than we can from the 3-month T-bill. However, during periods of great economic uncertainty, like right now, that spread goes negative. It goes below zero. And this is what's called yield curve inversion, when we can get more interest on the 3-month T-bill than we can on the 10-year Treasury. What's of interest here is that the yield curve inverts or goes negative right before the recession, like it did in the late 60s. You can clearly see here's the inversion and then the recession. The recessions are the gray bands on this graph, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, and recession. And look where we're at now in 2024. We are extremely inverted. So we have a recessionary indicator, yield curve inversion, telling us that there's a very high chance of a recession in the next, say, 1 or 2 years. This indicator has preceded every one of the last 8 recessions. So let's say that maybe the probability of a recession is 80% in the next, say, 1 or 2 years. We know that whenever we have had a recession, 93% of the time, we will have a loss in the stock market. So that tells me that the likelihood of a loss in the next 1 or 2 years is approaching about 74%. Now, what about a bear market? How likely are we to see losses greater than 20%? Okay, we're kind of gauging the magnitude of potential losses now. Well, if we're 80% likely to have a recession, and we know that 67% of the time in the last, say, 15 recessions, the loss has been 20% or greater, we're probably looking at about mid-50s, say 54 or 55% probability of a bear market in the next 1 or 2 years. Now, I don't believe in market timing per se, but I do believe that knowing where you're at in the business cycle can help guide your decisions on asset allocation, risk tolerance, and style of investment. In past recessionary periods, dividend-paying stocks, value-oriented stocks have done a lot better in terms of performance than growth stocks, i.e. tech stocks. So now is a great time to be reviewing your financial plan, your asset allocation, your investment strategy, and maybe tilting some of your investments over to strategies that have worked in past recessions. Look, we have very high odds of a recession. We might not get one, and hopefully we don't, but why not prepare for it? Why not prepare yourself for what might come down the road and pretty soon? In the long run, the probability of making money in the stock market is excellent. For all 1-year periods, if we look back 100 years, we had 74 positive years and 26 negative years for a 74% probability that in any given 12-month period, you're going to have a positive return. When we hold stocks for 3 years, if we look at all 3-year periods, going back to 1922, 85% of the time, you made money after 3 years. At 5 years, you had 88% probability. And with all 10-year periods going back to 1915, 96 of them, 96%, were positive if you held for 10 years. So to sum it all up, odds of a recession, very high. Likelihood of losing money in the next year or two, very high. But I do think that market timing is something to avoid. And the best way to handle the uncertainty ahead of us is an asset allocation that you believe in and tactically changing your style of investment for investment strategies that tend to do better during recessionary times. I hope this video was helpful. I hope it got you thinking, helps you better analyze your finances, and overall improve your family's financial plan.